This is Nightly Business Report with Tyler Matheson and Susie Guerin.
Bailout bummer. Initial enthusiasm over a deal in Cyprus quickly turns sour as investors ponder the precedent it sets.
Pay for delay. Why deals between big pharma companies and generic drug makers have ended up in the Supreme Court, and what it might mean for the price of your prescriptions.
And loan lawsuits. Graduates are struggling to pay off their loans, and now they find themselves being sued. But where the lawsuits are coming from may surprise you. All this and more coming up right now. Good evening, everyone, and welcome. Susie, you know, stocks had an early sprint out of the starting gate, but then it was a day of reversal.
We can call it a day of being whipsawed, right, Tyler? A Eurozone bailout deal for Cyprus sent the S&P to near all-time high territory at the start of the session, but then stocks turned sharply lower after comments from the Dutch finance minister that the Cyprus deal, which puts the brunt of the bailout costs on bank bondholders, stockholders, and wealthy depositors, could be seen as a template for other troubled banks in the region. He later backed off that statement, saying that the problems in Cyprus are unique and not a model for failing banks in other nations. Well, that helped the markets come off the lows of the session. In the end, the Dow was down 64 points on the day, closing at 14,447. The Nasdaq lower by nearly 10. The S&P 500 off by 5 points.
More now on that bailout for Cyprus, the country finally reaching a deal with other European nations, but it is a painful one, and it has broader implications for investors. Michelle Caruso-Cabrera is in Cyprus.
Cyprus asked the other European countries for financial help to bail out its two big sick banks. But Europe is tired of bailouts. Cyprus is the fifth country to ask for money. So this time, the Europeans said, before we give you any help, you'll have to downsize those banks dramatically. Well, to the people of Cyprus, that doesn't sound like a solution at all. Thousands of bank employees took to the streets this weekend as news spread that the bailout plan could mean thousands of them lose their jobs.
I'm going to lose my provident fund as well, my money.
Your pension fund?
My pension fund, my money. They were deducting them from my salary every month, and I'm going to lose every penny with no job, no pension, no money, nothing.
The painful deal comes more than a week after Cyprus shut down the entire banking system because its two biggest banks were on the verge of collapse. With only the ATMs working, lines could be seen day after day. That is until the withdrawal limit was steadily lowered, first to 260 euros and now only 100 euros at Laiki, the country's weakest bank, now set to be eliminated. Supermarkets were packed all weekend long for fear of shortages. With the banks closed, businesses can't pay suppliers and restock their shelves. Olga Kandinsky buying so much, she brought her two teenage sons to help.
We are concerned that there will be shortages of food, so definitely we want to make sure I have a family, I have to feed my family.
With this deal, investors are also on notice. European taxpayers will not necessarily protect you as they have in the past. With each subsequent bailout, the Europeans have gotten tougher and tougher. At first, senior bondholders in banks could be sure they would be protected, but they weren't protected in Cyprus. That's a message for the future. For Nightly Business Report, Michelle Caruso-Cabrera, Cyprus.
Despite that news of the Cyprus bailout today, it was still a nerve-wracking day for investors. Joining us now with more analysis on what's next for the markets, Doug Sandler. He's Chief Equity Strategist at Riverfront Investment Group. Doug, I want to pick up on these comments that really spooked out investors today from that Dutch finance minister, first saying that this bank bailout in Cyprus could be a template for future bank bailouts, and that banks could look to their own customers to help in a bailout. How should we factor this into our thinking as American investors?
Well, I think the bank solution in the end wasn't all too surprising. In the end, the good news is the insured depositors. The EU stuck to the contract they have with those depositors, so that's good news. I think what it means to the U.S. is, you're likely to get some black clouds appearing on the horizon. But in the end, I think it's wrong to believe that the safe place to sit in this market is on the sidelines. The 30,000-foot view that I think investors have to take is there's a lot of debt, and it's currently in the public sector. And that public sector debt is ultimately getting transferred to taxpayers, as it always does. So in the end, you're going to see taxes rise, you're going to see low interest rates, zero interest rate policies, and you're going to see quantitative easing. And the investors that sit on the sidelines are going to see, one, no return on their money, and two, they're going to see the value of their money eroded underneath them.
Doug, I'm going to figure that Cyprus is going to recede as a tension point here over the next couple of months. But my question for you is, do you think that U.S. equities have had their gains for 2013?
I think we made a quick leap into the year, so I'd say on the valuation standpoint, they may have. So when we look at U.S. equities, you really get, your prices go up for two reasons. One is the earnings go up, and two is the valuation multiple assigned to those earnings goes up. So year to date, we've seen about a 10% increase in the S&P. That's mostly due to valuations going up. I think that game's probably in the later innings. But I think there's plenty of room for earnings to grow. And earnings grow as a result of people having more jobs and buying more things, result of the housing crisis being behind us, and all of a sudden people feel more confident and their house price goes up and they put money into their homes and into other things. I think there's plenty of potential for earnings to grow. And, there's a lot of good news going on in the U.S. You have a manufacturing renaissance, you have a really energy bonanza, and a lot of these things are going to equate to higher earnings. So I think the market can go higher. I think there's a real risk of having too much money in non-productive assets on the sidelines.
You know, Doug, for a long time, individual investors were fearful of the markets and saying they were too scared to get into the markets. And now they're so scared that they've missed this market rally. What do you say to your clients when they bring up that question to you? Is it too late to buy in now?
Well, so I think a lot of people look at the last couple of times the market was at these levels. So in the year 2000, the year 2007, and now again today, the S&P was at about 1550. What I would point out is those were very different valuations. In 2000, the market was trading almost near 30 times earnings. In 2007, it was about 16 or 17 times earnings. And today, it's at 14 times earnings. So the stocks, even though they're at the same price, there's much more earnings underlying them and providing a foundation for valuations. So I believe, one, is valuations are fair. And then we see central banks around the world have kept interest rates low and are quantitative easing or printing money. In the end, those dollars will flow into stocks and make them go higher.
Doug, I want to come back to earnings, which you think are going to go higher, but I've been reading estimates that the first quarter earnings aren't going to be particularly positive compared with a year ago. Are you expecting the second half or the second 3 quarters of this year to be better than the first quarter in terms of earnings growth? Quickly.
Yeah, I mean, Tyler, that's probably the best news I've heard all day, which is that expectations are low. In the stock market, there's this thing I call the phenomenon, or the report card phenomenon. And that is, if you're expecting Ds from companies and they come in with Cs, it's a positive surprise. And that's what happened in the first quarter. I think it's again going to happen in the second quarter, that expectations are still pretty low. Remember, we're just coming off a fiscal cliff and a sequestration process. So estimates are pretty low. In the end, I think companies will beat them, and I think the market will respond positively to that.
All right. Thank you so much, Doug. Doug Sandler, Chief Equity Strategist at Riverfront Investment Group.
And to our market focus now, and we begin with Dollar General. The company's earnings did come in well above expectations, and the retailer says its strategy of selling more food and other basics will help drive gains. The company, with more than 10,000 stores in 39 states, is a barometer for low-end retailers. Shares gained during the day, ending up over 2%. Dell has 2 alternate buyout proposals to consider now. The company announcing that Carl Icahn has offered $15 a share for 58% of the company, and the private equity giant Blackstone has offered more than $14.25 a share. Both offers are better than founder Michael Dell's deal on the table at $13.65 a share, and the shares have traded above that price virtually since Dell made his offer, and they were up more than 2.5% today, closing at $14.51. Well, investors seem to like Best Buy's announcement that founder Richard Schultz will return as chairman emeritus and add 2 of his former colleagues to the board, including a former CEO. The move was seen as a positive for the troubled chain because Schultz won't sell his 20% stake in the company. Shares almost 2% higher today.
Apple says it's bought Wi-Fi Slam. This is a startup that lets consumers be tracked wherever they are by using Wi-Fi hotspots on their phones. This service will help shoppers, for example, find merchandise in retail stores or find a restaurant in an airport. Apple reportedly paid $20 million for the company. Shares of Apple rose almost $2, closing at $463.58. Apollo Group, which operates the University of Phoenix and other for-profit education institutions, out with its earnings today. The company reported a 79% drop in quarterly profits due to lower enrollments. But the results beat analyst estimates, and the stock was the biggest gainer in the S&P today, up more than 7%. And coming up a little later in the program, we'll look at why some college graduates are having trouble with education debt and what some schools are doing about it.
And also still ahead, the Supreme Court hears a case that touches the wallets and the medicine cabinets of most Americans. But first, take a look at how the international markets finished the day. Some good news about prices at the pump to tell you about. Average gasoline prices fell a little more than 3 cents a gallon over the past 2 weeks to $3.71 nationwide. That according to the Lundberg survey of fuel costs. The city with the highest average price in the lower 48 states? See if you can guess. Chicago, $4.10. Lowest average price, just $3.33 a gallon, is in Billings, Montana.
Just days after the Senate passed its first budget in 4 years, Bill Dudley, president of the Federal Reserve Bank of New York, told the New York Economic Club that the fiscal drama in Washington is a drag on the economy.
The fundamentals underpinning the U.S. economy are improving, and that monetary policy is gaining traction. But this may not immediately lead to stronger growth because of the recent increase in fiscal restraint.
Also in Washington today, the Supreme Court hearing arguments in the so-called pay-to-delay policy by some pharmaceutical giants, which cut deals with generic drug companies to keep their cheaper versions of brand-name medicines off the market. Critics say it's anti-competitive and ends up costing consumers more money. Bertha Coombs has more on today's hearing and the controversy behind it.
Americans have overwhelmingly embraced generics over brand-name drugs, accounting for nearly 85% of all prescriptions in 2012 at a big cost savings.
Drug prices decline about 90% once there is full generic competition on the market. So brands are basically obliterated.
But the government is asking the Supreme Court to consider whether consumers have been cheated out of even more savings by so-called pay-for-delayed drug patent deals that keep generics from coming to market sooner. The case involves the testosterone replacement drug Androgel, with $400 million in annual sales. The drug's distributor, Solvay, struck a patent settlement with generic maker Watson Pharmaceutical in 2006. Which keeps the generic off shelves until 2015 in exchange for a fee. The companies argue 2015 is 5 years earlier than the actual patent expiration. The industry contends in reaching such settlements for drugs like the blockbuster Lipitor to treat cholesterol, which went off patent last year, consumers have benefited.
Lipitor is coming to the market 5 years before the expiration of the patent, saving $4.5 billion per year. This is one of many patent settlements that involved some kind of consideration that save consumers and the federal government billions of dollars.
AARP and the AMA argue settlements allowing big pharma companies to pay generic makers to wait undermine competition and doctors' ability to provide cost-effective options for patients. Over the last decade, more than 60% of drug patent cases were settled. Of the cases that went to trial, analysts from Deerfield Institute found generics lost 52% of them. Pharmaceutical analyst Barbara Ryan says patent timelines stretch without deals.
These deals have been structured such that generics will get on the market before the patent expires that the brand name company is protecting. And I think that is the integrity of these deals.
The justices had tough questions for both sides during today's hearing. A decision is expected by late June. I'm Bertha Coombs for Nightly Business Report.
And here with his thoughts on what's at stake, Jeff Brennan. He's the former Healthcare Services Chief at the Federal Trade Commission, currently a partner at McDermott, Will and Emery. Welcome, Jeff. You know, this is a complicated, somewhat gnarly set of rules that pertain in these cases. The simple question, I guess, is who's winning and who's losing here? Are consumers losing? Are drug companies winning? Or is it just not that simple?
It really isn't that simple. It really depends on your view about this paradigm which the FTC is challenging. The FTC would say, and its supporters would say, that in a settlement agreement in which the brand company, the innovator company, pays money to the generic, that has the effect of delaying generic competition. Generics enter the market at a lower price, and so the longer that takes, consumers are worse off because they don't have an option for a lower priced alternative until a later time in the future. The opposite response to that by the parties who enter into these agreements is that the brand, one must remember, has a patent protecting some aspect of its drug product. In fact, these are patent infringement litigations that are getting settled, and patents convey a right to exclude competition lawfully. It's a fundamental aspect of our economy, and it helps support why innovator drug companies invest the R&D monies over a long period of time to develop new drugs. And that so long as the patent settlement agreement provides for generic competition before that patent expires, consumers are better off because they're getting competition sooner than they would if the patent ran its course.
But what happens, Jeff, if the FTC wins this case and everything has to go back to court? All the parties have to pay enormous costs, a lot of time to work through their differences. In the end, doesn't the consumer end up paying more money? Doesn't that increase the costs anyway?
Well, that could happen if drug companies need to spend more time in the courtroom paying people like me, attorneys, to litigate their cases. That raises their costs, certainly, and costs, as we all know, in a market economy, ultimately at some point and at some level get passed along to consumers. So from that perspective, certainly the drug companies would point out, as you mentioned, that a rule that had a tendency to extend litigation rather than help terminate litigation and move on have costs for consumers that need to be taken into account.
So the FCC basically says if these lawsuits proceeded, in other words, the generic company that's suing to overturn a patent, if they proceeded, then the consumer might get those generics sooner than they otherwise would. The branded drug people say, well, we're doing a deal where we're going to bring generics or allow generics in return for a fee to come to a market sooner than our patent would allow if we were to prevail on the patent case. I guess what stands out to consumers would be the idea that there is something that sounds vaguely anti-competitive about one company paying another company a fee, quote, not to compete. Have I got that right?
You've described that quite well, the situation. I mean, I think one thing that's worth keeping in mind, these are not, as one of my former colleagues once said, it's not a bag of cash that's being handed surreptitiously from the brand to the generic. These are in connection with ancillary agreements in the settlement agreement that have their own stand on their own two legs, if you will. A co-promotion agreement with the generic drug company to promote the product to, in this case, urologists, a joint development agreement, to a joint venture to develop a new innovative product, a supply agreement, things of that nature. So this isn't just cold cash going from one side to the other, but it's in conjunction with other arm's length transactions.
Very quickly, decision on this expected when? June, end of the term?
Most likely end of the term. You know, we could be surprised, but I think most people are thinking about June.
Jeff Brennan, former head of the FTC's Healthcare Services Division. Thanks for being with us.
Thank you.
Americans owe roughly $1 trillion on student loans, more than they owe on credit cards. And if that's not enough, college graduates are increasingly being sued by the universities they attended to pay back the money they borrowed. Tonight, we begin a three-part series, Hitting the Books. Scott Cohn reports on how scholarly efforts are turning into degrees of debt.
Aaron Graff is 30 years old and just getting by.
Maybe I have $100 spending money a week, and spending money means gas, means food. I don't go out to eat.
He teaches high school equivalency courses and does some remodeling on the side, all to pay around $600 a month on his $60,000 in student loans.
I'm basically paying rent twice.
And now he has a court judgment against him. George Washington University, where Graff earned a degree in 2010, sued him last year for non-payment of a $4,000 federal Perkins loan for low-income students. Graff, who previously spoke to Bloomberg News, says he is paying his other student loans, but something had to give.
Well, I guess I could get another job where I'm working 17, 18 hours a day.
The university wouldn't talk about Graff's case, but says in general, litigation is a last resort, a view shared by administrators across the country.
By and large, though, I think most institutions are trying to work with their students.
The problem is that delinquent student loans are growing, passing late credit card payments for the first time, and federal law requires schools to collect and sometimes sue. Unlike most forms of debt, you can't get out of a student loan, not even by declaring bankruptcy. But with delinquencies rising and budgets shrinking, lenders and colleges are getting more aggressive about collecting, including taking their alumni to court. We found cases filed by Yale, Temple, and the University of Pennsylvania, which filed some 24 suits just last year for bad loans and unpaid tuition, a 35% jump from the year before. The university has declined to comment. Graff hopes his case starts a dialogue.
Let's start to talk about why is college so expensive? What is it that we're getting for our money when we put our money into these institutions?
It's a conversation colleges are willing to have, but they also want their money. Scott Cohn for Nightly Business Report, Philadelphia.
Such a tough situation. First of all, a lot of these graduates, they have all these loans or debt, and they don't have a job.
They can't find a job.
They can't find a job. And even if they find a job, it's going to take a long time to pay off $60,000, $100,000 or more.
This is why so many of the schools are going to lower-priced online courses as a way to reduce, actually to reach a broader audience, but also to reduce the amount of money that is required from the student to get in there.
Nothing beats that classroom teaching.
No. Of course, money management is a lesson we all need. And tomorrow, in part 2 of our series, Sharon Epperson is going to report on the growing demand to make financial literacy a core requirement in high schools across the country.
Coming up a little later on the program, too young to retire, but not too young to buy a retirement home. We'll look at the new wave of buyers snapping up real estate in some unlikely places. But first, here's how treasuries, currencies, and commodities closed out the day. Let's take a look now at what we're watching for you for tomorrow. We'll get a report on durable goods, which measures, among other things, the appliances going into new homes. Speaking of homes, S&P releases the Case-Shiller Home Price Index for January, and Robert Shiller will be our guest on Nightly Business Report. We'll also get the latest numbers on new home sales for February.
And speaking of housing, house prices are generally moving up these days, but considering how far they fell in some states, including Florida, bargain hunters, some of the most unlikely shoppers, are still finding lots of values. Diana Olick has more.
At Century Village Retirement Community in Boca Raton, senior citizens get in early for yoga, but not Charlie Roque.
No, this is my little getaway place.
At 56, he is neither a senior citizen nor a retiree. What he is an astute buyer.
I bought an apartment that not long ago was valued at around $75,000, and I picked it up for $20,000. So the value comes in the surroundings. It comes with the clubhouse. It comes with the peace of mind that I have someplace. I know that if I need to go there, I can go there.
From the height of the housing boom in 2006 to the bottom in 2011, home prices in Boca Raton fell 53%, according to Zillow.com. Now they're heading up again, and that has created a great opportunity for home buyers of any age.
While the median age here at Century Village may be coming down, you still have to be 55 years old to live here. But that hasn't stopped younger investors from jumping right in, taking advantage of the low prices and waiting it out till retirement.
They see a significant uptick in property values increasing and inventory drastically decreasing. So they've elected to buy now.
Schachter estimates that now 10% of Century Village residents work either full or part-time. The vacancy rate for the community is around 2% because low prices are luring buyers. As for his older neighbors, Charlie Roque has nothing but respect, but he doesn't know many of them because he's usually out at work. For Nightly Business Report, I'm Diana Olick in Boca Raton, Florida.
Well, this is obviously a very interesting angle on investing in real estate, but I'm hearing more and more from people saying that I wish I had bought some properties during the downturn because they feel there's more of an upside than investing in stocks.
No, absolutely. Some of those prices came down so far, but it took a brave human being to go in there at the depth of the housing crash in those cities like Miami, Las Vegas,
right.
Riverside County in California. Really takes some nerve to do it. I didn't do it. I'll tell you
I
that.
didn't do it either. Well, that's it for us. Nightly Business Report for tonight. I'm Susie Garrow. Thanks so much for watching.
And I'm Tyler Matheson. Have a great evening. We'll see you back here tomorrow night.
I'm Susie Garrow with the Nightly Business Report News Brief. The markets were whipsawed today. A Eurozone bailout deal for Cyprus sent the S&P to near all-time high territory at the start of the session, but stocks turned sharply lower after the Dutch finance minister said the deal, which puts the brunt of the bailout costs on bank bondholders, stockholders, and wealthy depositors, could be seen as a template for other troubled banks in the region. He later backed off that statement, and the markets came off the lows of the session. In the end, the Dow was down 64 points, the Nasdaq lower by nearly 10, the S&P 500 off by 5 points. Yahoo paid $30 million for a mobile app maker that culls news sources for smartphone users. The founder of the company, just 17 years old. Be sure to tune in to Nightly Business Report right here on your public television station.